Iron Financial, everyone. It is a huge day for bank earnings, and we are digging deep into the reports to find out what is really going on under the hood. Let's get right into it. So, on the surface, we're seeing these big, flashy headline numbers, right? Record profits. Everything looks great. But we're here to hunt for the real story. Are there cracks forming in credit quality? And how are these companies really spending your money? Let's find out if this strength is for real or just a paper tiger. All right, here's how we're going to tackle this today. Think of it as a contest, a showdown. In one corner, we've got the big dogs, the major regional banks you all know and follow. And in the other corner, we have the Wildcards. These are the specialist firms that can give us a really unique read on the health of the economy. We're going to break them both down to find the day's hidden gem. Okay, first up, let's put the big regional banks under the microscope. It's time for a sector health check to see what their reports are telling us. And kicking things off for us is PNC Financial. Now, they're a huge player, so their report really helps set the tone for the day. Let's see how they stack up in our stoplight review. So the contrast here is really what matters. That green light, it's fantastic. Record revenue, $7 billion in net income. You can't argue with that. But, and it's a big but, the yellow and red lights tell a totally different story inside their core retail banking division. Expenses are creeping up, and earnings actually fell from the last quarter. Kind of looks like the main engine is starting to sputter a bit. So let's drill down into that yellow light. The report explicitly calls out technology investments as a driver for that 2% jump in expenses. Now, this is a theme we're going to be watching all day long. Are these smart investments that are going to pay off down the road, or are costs just starting to get out of control? For PNC, it's definitely starting to chew into the profits of their most important segment. Okay, next up is Regions Financial. Let's see if their story confirms this trend we're seeing or if they paint a different picture entirely. For Regions, that green light is their balance sheet. It's a fortress. A common equity Tier 1 ratio of 10.8% is very, very strong. But here we go again. Look at that yellow light. Expenses are up almost 6% from this time last year. And the red light is a big one. They're actually guiding for net charge-offs, that's basically loans going bad, to be in the 40 to 50 basis point range. And this just perfectly illustrates the contradiction you see on earnings calls. You've got the CEO, John Turner, saying, hey, don't worry, credit quality issues peaked a few quarters ago. But then their own guidance, that 40 to 50 basis points, suggests they still expect a pretty decent level of loan losses to come through. That's a disconnect you've got to pay attention to. All right, let's keep things moving. Next up on the docket is M&T Bank. Their story this quarter is really all about one thing, what they're doing with all their cash. M&T's message is coming through loud and clear. They think their stock is an absolute bargain. They spent over $500 million in one quarter buying back their own shares. That is a massive vote of confidence from management. Yeah, the trade-off is a tiny dip in their equity ratio, but honestly, this is a very clean report with a laser focus on returning cash to shareholders. And now for our final big dog, the custody bank, State Street. And folks, this is where the story on expenses gets really interesting. And frankly, a little bit alarming. So the green light looks fine. Revenue's up 7%. But that yellow light is a classic sign of trouble. Whenever a company keeps talking about their results, excluding notable items, you really have to start asking what exactly they're trying to hide. And that red light? It's flashing bright red. Total expenses jumped over 12% year over year. That's a huge number, and it basically wipes out all of their revenue growth. And when you dig into those expenses, one specific line item just jumps right off the page. Their spending on information systems and communications is up a staggering 16% year over year. Which brings us right back to that critical question. Is this a strategic investment in tech that's going to pay off in the long run? Or is this just uncontrolled spending, a cash bonfire with very little oversight? A 16% jump in 1 year for a company of this size is a major, major red flag for us. Okay, that's it for the big dogs. Now let's shift gears and move to the wild cards. These are the specialists that can often give us a better, more focused signal on what's happening out there in the real economy. First up is the global IT consultant, Wipro. We like to look at companies like this to get a reality check on corporate spending and on one of the biggest buzzwords in the market today, artificial intelligence. Is all that hype actually turning into real revenue? So you hear the CEO, Srini Pallia, talking a big game. AI is a strategic imperative, it's emerging as a differentiator. This is exactly the kind of talk that gets investors really excited. But as we always say here, you have to look at the numbers. And the result of all that talk? A 0.2% year-over-year increase in IT services revenue. Let me just say that again, 0.2%. This is a perfect example of the hype getting way, way out ahead of the reality. Okay, now for one of my personal favorite companies to follow, Hingham Institution for Savings. It's a small community bank, but they are so ridiculously disciplined that they serve as a perfect canary in the coal mine for credit quality. You know, what makes Hingham so special isn't really what they do. It's what they don't do, as you can see from this list. No commercial loans, no auto loans, no credit cards. They avoid crypto, cannabis banking. I mean, the list just goes on and on. They stick to one thing they know, high-quality real estate lending. And here is the beautiful results of that discipline. This chart is from Hingham themselves. The blue bars, that's the net charge-offs for the entire FDIC-insured banking industry. And those tinny red bars, basically a flat line at zero, that's Hingham. For decades, through crisis after crisis, their loan losses are practically non-existent. It is an absolute masterclass in conservative banking. And that brings us to our final company of the day, a regional player out of Tulsa, Oklahoma, BOK Financial. After looking at all these other reports, I gotta say, this one might just be our standout. And here it is, the single most stunning, jaw-dropping number from today's filings. BOK Financial's provision for credit losses in Q4 was zero. That's right, zilch, nada. They did not set aside a single dollar to cover future bad loans. And this wasn't a fluke. That zero provision signals supreme confidence in their loan book. And on top of that, they actually grew their commercial loan portfolio to over $15 billion, and they were opportunistically buying back their own stock. It's just a powerful combination of confidence, real growth, and smart capital allocation. All right, we've gone through the big dogs and the wild cards. We've seen some good, some bad, and some downright ugly. It is time to put it all together and render the official Iron Financial verdict. So after all that analysis, which of these companies looks like a hidden gem that the market might be missing? And maybe more importantly, which one is showing enough red flags to tell us to stay far, far away? Our stay away pick for the quarter, the one with the most concerning report, it has to be State Street. The reasons are just crystal clear, and they're all right there in the numbers. A 12.3% jump in total expenses is just out of control. That 16% explosion in IT spending raises serious questions about their cost discipline. And the constant reliance on adjusted numbers tells me that management is trying to obscure their performance, not clarify it. There are just way too many red flags here for us. And that brings us to our winner. The hidden gem of this earnings season, the company that truly impressed us, is BOK Financial. I mean, this was just the cleanest report of the day, hands down. Setting aside $0 for credit losses is the ultimate signal of confidence in your loan book. They backed that confidence up with real, tangible growth in their core commercial lending business. And they were intelligently buying back shares. It's a simple, powerful story of a well-run bank just firing on all cylinders. So we'll leave you with this final question to chew on. We saw it with PNC and we really saw it with State Street. Is this explosion in tech spending the new hidden risk in the banking sector? Is it a smart investment for the future, or is it just a black hole for shareholder capital? It's a key theme we'll be tracking all year. Thanks for joining this deep dive from Iron Financial.
I am not a financial advisor. This is for educational and entertainment purposes. Do your own research.